Holy smokers, that ain't no dang jokers, ladies and gentlemen. Look at some of those moves in the public count. Public count continues to roll on here over the last few weeks. Look at Elf on a Shelf up 8+% here today. It's a $6,000+ move. That one jumped back to 1,000% plus gainer for us. Honest was up over 5% today. Look at Palantir at a 3% plus move. You had Celsius up almost about 3%. That was about a $5,000 move there. Estee Lauder EL up over 2%, American Express up over 2%, Revolve up about 2%. So definitely some nice moves out there. Google McDougal, congratulations to anybody that's a Google shareholder out there. Man, what a stock this has been. New high after new high. Closes today over $320 a share. Look at, we just had the flip happen, which is where you have made more money in a stock than what you put in, and that has now transpired for us in regards to Google. Back in April of this year, I put $69,000 in the stock, and now I'm sitting on a $72,000 plus gain. So that is always fun to see. AMD continues to bounce back strong. That stock 217 plus here today. Just last week, people were panic selling the stock for $195 for who knows what reason. I can't even remember. It might have been because of Google's chips. I can't even remember at this point in time. But they were panicking last week. Now they're buying it back left and right. 217, 250's coming up here next, right? This was a very interesting situation. I had CNBC on in the background while I was working today, and then all of a sudden I heard them talking about C3 AI earnings were coming out. I was like, oh my gosh, I forgot all about that company. 3 years ago, this company used to get put into the same sentence as Palantir. People thought Palantir and this company were the same, right? And look at the result difference between these two stocks over the past 3 years. If you were in Palantir over the last 3 years, let's be very crystal clear. You made life-changing money. Life-changing money. That stock is sitting on a 2,600% gain in the past 3 years, while C3 AI is sitting on a 27% gain the past 3 years. Keep in mind the S&P 500's up about 76% over the past 3 years. So you either had a situation where you had life-changing money in one stock, or you underperformed the stock market by a massive amount. And think about the difference in what your lifestyle could be, like where your portfolio could be, all those things. If you'd picked, and there was definitely some people that picked C3 AI 3 years ago, and like that was going to be the winner chicken dinner. And some of us, like myself, we picked Palantir and we made life-changing money on that stock, right? 3 core subjects I want to speak about here today in this one. First one up here, how do you avoid a situation like a C3 AI versus Palantir? Okay, because that's going to be actually the most important thing we'll talk about here today in this video. I'm just going to drop some gems for you guys, because you might get into a situation down the road where you picked the wrong stock and you had an option between two and you picked the wrong one. You don't want to get into that situation, okay? Because imagine you look back and you're like, I'm sitting on 27% gain on C3 AI. I could have made 2,600% in Palantir. Like, you don't want that to happen to you, okay? So we'll talk about how to avoid that. Second thing we'll get into is a newish stock that I spent $30,000 on here today. Why I put another $30,000 into the stock? It's kind of a somewhat recent buy for me in regards to me getting involved with this stock, okay? So, third subject we'll speak about here today in this video is my favorite fatty paying dividend stocks. Okay, we'll speak about that in this video. It's an action-packed one. I hope you guys enjoy this one. I hope you appreciate it. The only thing I ask from you in return for this video is that sign in my garage says it. Smash that like button. Hit that little thumbs up icon for me. That means the world. If you want to be subscribed to the channel and you want to see more of my videos in the future, make sure you're subscribed. It is free to do so. And I think we're at, oh gosh, I don't know, 906,000 or 907,000 subscribers now on the channel. Appreciate each and every one of you for being here. Pin comment down there today. That'll be if you're looking to apply to my private stock group, private wealth group, take your investing game up to a much higher level than where you're at today. That's access to all my course curriculums, the private Discord chat, access to 1000xstocks.com, see all the moves I'm making in my portfolios. It's been an action-packed year. We're now up to 3,138 members in the group. We are shutting down to new members at 3,300 members, okay? And we'll open it back up at some point in time in 2026. My guys need a break. It has been ridiculous this year, and so we're about to close this thing. So we got 162 spots open, which is not a lot. I'll just tell you that. That will probably be, honestly, probably in the next week or two. We'll likely, finish that off. So 3,300, that's where I'm closing the group at for this year. And at some point in time, when we catch our breath, I'll open it back up to new members in 2026, okay? And keep in mind, this is pretty cool. Some people have been sending me these messages on Instagram, posting on X and whatnot, posting on their Instagram, X, and it's like, I guess YouTube is sending out like what channels you watch the most, and like, one subscriber sent me, this is so cool, top 0.7% of viewers. This person said they're in the top 2%, so that's cool. I don't know how YouTube's doing all that, but cool stuff. Okay, alrighty guys, so let's talk about how to avoid a C3 AI versus Palantir situation here. Okay, so if you want to know what are the things that you could learn in this life that will make you the most money, okay, there's a few things, but one of those few things is financial analysis. The ability to understand businesses, the ability to understand financial statements, run valuations on companies, right, and analyze the situation and be able to tell, is a stock a good buy or not a good buy, right? I figured that out way back in 2009. I kind of got acquainted with the stock market in 2008. And then 2009, I started figuring out, oh my gosh, like this could be the highest income skill I ever, have in my entire life. Like this could change my life if I really get this skill done. And I was passionate about it and I love doing it and still love it to this day. And, about to be 2026, right? And so moon's already out here in Vegas. And look at that. Moon's out and it's 4 o'clock. You gotta be flipping my flapjacks, man. Days are too short this time of year. So I figured that out way back in 2009. Every single person watching this video, you better understand financial analysis if you want to make a lot of money in this life, because I can tell you, pays very well. Pays very, very well to understand that. Okay. No. I was actually texting with a friend here today. He was talking about, basically like hedge funds and, not that impressed by them. They don't even have very good returns and things like that, right? And keep in mind, if you're watching this video, you probably don't have the opportunity to invest, start your own hedge fund, right? You are in a situation where you're investing your own money. I said, that's because they spend all day golfing and steak lunches with their clients rather than looking into companies. The industry is a joke for the most part. I said, like everything in life, you have 1% that are amazing, legendary, right, in the hedge fund community. 10% are good, 50% are meh, 10% are trash, 29% are super trash. So now look at yourself as a retail investor, as an average Joe investor, okay? And you're going to understand that the differences here is monumental in regards to where your financial life is at, in the type of lifestyle you're able to provide or not provide, right? If you're in the top 1% of, retail investors, right, you're going to likely end up making more money than you ever dreamt, more money than you know what to do with. Like, you're like, I don't even know how to spend the money fast enough because I made so much money in this game, right? If you're in that top 1%. If you're in the top 10%, we can call it roughly, right? You can likely create generational wealth. If you're doing this for many decades and you're good at what you do, stock picking, investing, running portfolios, you can likely create generational wealth that can last several generations of your family, right? If you're in that 50% bracket there that are kind of meh, if you're doing this over many decades, you might still be able to at least retire comfortable, right? That does not mean you're ever going to be able to really achieve all those dreams you really wanted to and live in that dream house and drive that dream car and go on that dream vacation and, all those sorts of things. But you could likely have a comfortable retirement, right? Now, if you're in the 10% that are trash, you're going to have a struggle making it. You're going to have a struggle making it. Now, if you're in the 29% that are super trash, you're working at Walmart at 80 years old. Just no other way around it, like greeting the customers coming in. By that time, robots are going to be greeting the customers, so they won't even need you. So it's going to be a tough sledding, right? And so you got to understand, you need to do everything in your power to get up here, because this is where you really want to be, right? And so sometimes people are lazy and they're comfortable being here, and it's like, do what you want, live your life the way you want to live your life. But gosh, it's going to be brutal, man. That is going to be brutal. A few things that are key to really understand. If you really want to avoid a C3 AI that destroys your wealth versus, a Palantir that just, absolutely accelerates your wealth in a massive way, right? One is you got to listen to conference calls. So important in regards to these companies. When you're listening to those conference calls, you're going to pick up on so many things that are happening in the business model that are going to be able to help you judge the business better. Because listen to this, okay? Guess what happened back in 2022? I was listening to a ton of Palantir conference calls, learning more about the business, watching as many Alex Karp interviews and other executive interviews as I possibly could, talking with other people in the Palantir community back then, right? And getting their thoughts and opinions and seeing if I'm missing anything here as far as bullish catalysts, bearish catalysts, or anything in between, right? Putting in the work, really like trying to study up on this as much as possible. That helped me out to understand Palantir on a much higher level to be able to invest in that company in a very comfortable way and get a $7-8 cost basis, whatever I have, right? It's incredible. Boom, game changing. If you don't listen to those conference calls, it's going to make it a lot harder for you to really understand a business on a high level, and you're not going to really know, is Palantir the winner chicken dinner over the coming years, or is it C3AI, right? Additionally, you got to do things like perform SWOT analysis, strengths, weaknesses, opportunities, and threats of a business. Very important. You always perform SWOT analysis on any company you're thinking about investing into. If you had done this with Palantir 3 years ago, you would have walked away feeling pretty good about yourself. If you did it on C3AI, I'm not so convinced. And then strong moat versus a weak moat around a business, very, very key as well. You do those things, that's going to help you and boost you up to a much higher level if you know what you're looking for in regards to that. Okay. Another thing that gave me a lot of confidence in Palantir versus a company like C3AI, even though people were grouping them together 3 years ago, right, is in the private stock group, we have the Discord chat, right? It's one of the most valuable parts of being in the private group outside of the course curriculums. And we have a Palantir chat, okay? And we have a lot of individuals in the private group that, are software developers and other key positions at different big tech companies and things like that, right? And what I came across time and time again when we would talk about Palantir, that a lot of people that were really in the industry would tell me, is Palantir had a one-of-one employee force, and it was incredibly hard to get a job at Palantir. Like, you could get a job at Google or Meta or Apple or somewhere like that before you could get a job at Palantir. It was incredibly hard. Like, their employee force was incredible at that company, right? So if you really have that special of individuals working at a company, right? Like, we're talking even maybe a tier up from the big tech companies. Good probability, whatever this company is going to build out for software is going to be magical, right? It's going to be game changing in regards to that. So that was another thing that gave me a lot of confidence, like really understanding, oh man. And I had this confirmed by several people about how special Palantir's workforce really was. And I was like, you got very extremely top tier talented people working at a company and they're all working together, they're going to create some pretty compelling products and services out there, right? Then what happened in early 2023 was a game changer. This took things to the next level. So what we had is what's called a fundamental change in a business model. A fundamental change can go one of two ways. It could be a fundamental change for the better, as this was, or it could be a fundamental change for the worse. Like some serious competitor came out for a company, they're going to damage that company, or something went super wrong with this company's product or service, and it's like a fundamental change that's going to alter that business's growth rates for years to go in the future, right? For Palantir, there's something fundamental that happened that if you identified this, it was like, oh my gosh, like this is a game-changing thing. So one of the things, one of the big problems Palantir always had was their sales cycle was incredibly long sales cycle, like brutally long. Like it could take them 6 months, 12 months to land a customer. It was such a slow sales cycle. It was almost embarrassing, right? But that changed when they launched AIP. And what happened is the sales cycle for Palantir went from a situation where it took many months or maybe even a year to all of a sudden a sales cycle could happen in hours or days. And that was a fundamental change for the better for Palantir forever. And they covered all this at the time. And keep in mind, Palantir had already been bouncing by the time this launched and by the time they started talking about it. But gosh, Palantir back then was still like a $15, $20, $25, $30 stock. It wasn't a $200 stock or 170 something, wherever it's at today, right? So you still had like time to recognize like there's a fundamental shift going on here, right? And you could have moved your money out of C3AI and recognized like, okay, the real opportunities here, Palantir and what they're doing, right? Additionally, here's another thing you could have looked at. You could have looked at C3I's revenue growth, okay, over time. And what you witnessed was something troubling in C3I's revenue growth story, okay? It was so inconsistent. So inconsistent, it wasn't even funny. Like, look at this. They went from 17% revenue growth down to 16%. Then they went up to 20%. Then they flatlined. Not good. Then they went up to 28%, then they went down to 26%, then down to 25%, then negative like almost 20%, right? Not good. That's so much inconsistency. And especially for a company that is more in the software space, right? That should not happen. Like you want to see consistent revenue. You know what you want to see? I'll show you what you want to see. You want to see what Palantir has been able to do. Look at Palantir. 16% revenue growth, 19%, 21%, 27%, 30%, 36%, 39%, 48%, 62%. Consistent growth, 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 quarter in and quarter out. That's a trend you want to see. So you had many opportunities to move out of a stock like a C3AI when you could recognize, okay, this isn't adding up. Why is their revenue growth not consistent here? Why, you had plenty of time. You could have moved out of the stock in 23, could have moved out of it in 24, right? And positioned in the real deal Holyfield. So even if you didn't identify it in 22, like I did and some others that got in at $6, $7, $8, $9 a share, you could have at least moved out and still made, honestly, great money. You probably still could have got yourself 200% return, 400% return, 600% return, right? You wouldn't have got yourself 2,000 or 2,600% return, but you could have still made 400, 600, 800%, right? Which is, last time I checked, a lot better than 20%, right? So, some things to keep in mind here, right? Now, you got to avoid gambling the market like the plague. Okay, a lot of people gamble money in the market. So I'm sure there were people back in 22 that gambled some money into a company like C3AI. They didn't really know what they were doing. They didn't know how to judge income statements, balance sheets, how to run valuations. They didn't understand how to identify business models, run SWOT analysis. And they gambled, right? You got to avoid that crap like the plague. That's going to come back to bite you hard. When I went to buy Palantir stock years ago, that was an investment, right? It was an investment. I looked at the company, I looked at the company's balance sheet. It was extremely solid. They were starting to improve their profitability massively. I looked at the product roadmap and what they had going for their products, and I said, okay, this looks pretty darn compelling, especially at the given valuation it was at that particular time. So I made a wise investment. If you don't know how to identify business models, financial statements, valuations, you're gambling money. You're just throwing money around hoping it hits, right? And that's the same thing people do down at the casino. I live in Las Vegas. They do it all the time, okay? Avoid this, do this. There's a big difference between gambling, straight up gambling and throwing money around, and actually investing and being like, I've looked fully into this. This is a great opportunity, right? We're back in business. Just last week, 5 people in the private stock group hit $1 million plus in their portfolios. 14 people hit $100,000 plus in their portfolios. Incredible to see. These people who don't gamble in the market, they've learned under me. They've gone through the course curriculums. They brought their game up to a higher level. They're not there to screw off. They're actually there to play this game on a high level, right? And they get the results. And these types of people that will stick to investing, stick to great principles, they'll continue to thrive over future years. They'll make it through the bear markets, out to the other side, and they're just have fun in the next bull market, and the next bull market after that, and the next bull market after that, man. That's what you got to do. If you've never seen these awards, by the way, this is the one I send out to the 6-figure members. It's very heavy, like diamond award, crystal award. It's pretty cool. And then this is a 7-figure one. We actually changed up the styling a little bit in regards to the 7-figure award, but those are expensive awards, and I ship them all over the world. And I never make anybody pay for them. I pay for them out of pocket. The awards, the shipping, a lot of times that's $100 or sometimes $200 between all that, and I pay for it out of pocket because at the end of the day, it's great to see people prospering and having success and things like that, and having something to recognize it, like a physical something, right? To recognize your success you're having out there in the market, okay? So there we go. Okay, next up here, newest stock I spent $30,000 on today, why I did it, and then we'll talk about some of my favorite fatty dividend paying stocks out there. Okay, so did you see the video I did 2 days ago on the channel? 7 stocks I'm buying now, December 2025 edition. What was the very first stock I talked about in that video? Do you remember it? It was a company named Salesforce. So I posted this inside the private stock group this morning, a little after 10 a.m. I said, I just did an abnormal big buy of $30,000 in a private portfolio. I bought CRM. They report earnings today. I wanted to build out my position more before earnings are released. I'm underinvested in the stock. My hope is the stock goes down as I want to buy more shares the next 3 to 6 months. If it doesn't go down and flies 10 to 20% after earnings, at least I built my position stronger. So it was a little over a $30,000 move. I let my private group know about it because it was an abnormally big buy. And so usually I just let the private group know about the Patreon buys and then the public account buys or sells, right? But since this was in a private portfolio and it was such a big number, $30,000 in a day, right? I thought I would let everybody know. And so, I went ahead and did it. Now, in regards to Salesforce, earnings are phenomenal. Stock's up nicely after hours. Now, in regards to this one, okay, and where do I see the stock going? And we're going to get into all that here. As far as the top line numbers go, revenue was basically in line. Earnings per share came in at $3.25 adjusted versus $2.86. So top line, very nice there. Now, few things here. If we look at current remaining performance obligations, came in at $29.4 million. That was up 11% year over year on a constant currency basis. So what we're going to see is accelerating growth in regards to Salesforce here. Remaining performance obligations came in at $59.5 billion. That's up 12% year over year. So that's a much stronger number than what their current growth rate is, which is actually what you want to see. If this was a lot lower number, let's say right now, they were growing revenue 12% and their remaining performance obligations were only up 8% year over year. Ooh, then we got a problem. We have the opposite going on. Third quarter subscription and support revenue came in at $9.7 billion. That was up 10% year over year and 9% on a constant currency basis. Third quarter revenue was up 9% year over year and 8% on a constant currency basis. So look at that. 8% revenue growth on a constant currency basis for this latest quarter, but remaining performance obligations were up 12% year over year. It's good. It's really, really good. That's what we want to see. Third quarter operating cash flow, $2.3 billion. That was up 17% year over year, so way stronger, over a double up as far as percentage growth versus revenue. That's something you want to see as well. In free cash flow, $2.2 billion. That's up 22% year over year. Woo! That's a good number there. They returned $4.2 billion to shareholders, including $3.8 billion share repurchase, and they paid another $395 million in dividends. They raised their full-year revenue guidance to $41.4 billion to $41.5 billion. That's up 9 to 10%. So basically, they're expecting revenue growth to accelerate here. Good. I mean, it's just good across the board. We are raising fiscal 2026 revenue guidance to $41.45 to $41.55 billion. And Q3 remaining performance obligations was exceptional, up 11% year over year to $29.4 billion, signaling a powerful pipeline for future revenue, said Mark Benioff, the chairman and CEO of very, very much a business legend. Our agent force, this is a product I talk about a lot that's going to be very, very key over the coming years, kind of like I've talked about Palantir's products, back in 22, 23. This is going to be key for Salesforce in 26, 27, 28. And Data 360 products in the momentum drivers, hitting nearly $1.4 billion in annual recurring revenue, an explosive 114% year-over-year gain. We now have 9,500 paid agent force deals and 3.2 trillion tokens processed, underscoring the leadership in building our agentic enterprise and driving real outcomes. Our Q3 momentum and continued agent force adoption further reinforces our path to achieve our $60 billion plus organic revenue target and our profitable growth framework target of 50 for fiscal year 2030. Keep in mind they said organic. Why they say organic? You know why? Because a company might buy other companies over the next several years, which will boost up growth rates. So they're talking about they can do $60 billion plus in revenue a year by fiscal year 2030, just off what they have right now, not even counting future potential acquisitions, right? Now, Agent Force, Data 360, oh my goodness. Woo, they almost killed me. I had to drink something there. Agent Force and Data 360 annual recurring revenue reached $1.4 billion, up 114% year over year. Agent Force annual recurring revenue surpassed $500 million in Q3, up 330% year over year. Agent Force accounts in production increased 70% quarter over quarter. We're not talking year over year. We're talking quarter over quarter. That's how much Agent Force is taking, the growth rate's up insane right now. And keep in mind, as this Agent Force becomes a bigger and bigger component of the business, revenue-wise, ladies and gentlemen, it's going to help out those revenue growth rates in future years, okay? Keep that in mind. It's just math. 50% of Agent Force in Data 360 Q3 bookings came from existing expansion. Salesforce has closed over 18,500 Agent Force deals since launch. Over 9,500 paid deals, up 50% quarter over quarter. Quarter over quarter. That's a 3-month span over a 3-month span. Incredible. Nearly 90% of Forbes' top 50 AI companies run on Salesforce with an average of 4 clouds. Listen, man, you can't, try to explain this to people, okay? You can't move away from Salesforce. It would be a disaster. You're a big company. Everybody's locked in with Salesforce. What are you going to switch from sales to who? Who are you going to get all these products from? So there's two stocks that are extremely misunderstood, I found, from the retail investor community. Salesforce and Adobe. People don't understand how big businesses work. They don't understand how these products work and how they're integrated, and that there is no other choice. There is no other option. You can't go with somebody else. It's going to be a disaster. You're like, we've got to get out of Salesforce. We're going to go. Who? Who are you going to? No one. There's a reason 90% plus of Fortune 500 companies use Salesforce, right? It's not just like magic. It's like they have all the products and services you need all in one spot. It's the most cost-effective way to not screw up your company. And so they just keep landing them, And then they come out with new products and services, acquire more companies, have more stuff to sell their customers. Keeps a huge moat around the business, and it's why people are willing to pay elevated PEs for a stock like this over time. You can't leave them, right? AI. Guess what? Salesforce is doing AI. They're going to integrate it for all these companies, and there's going to be no need to go. You think Coca-Cola is going to be like, we got to dump Big Dog, and we're going to go experiment with what are you talking about? Okay, no, that's not the way this works. It's like a fundamental misunderstanding of even business in general and how this stuff works. Okay. Now, as far as Salesforce income statement, grade A banger here. Revenue went to $10.2 billion from $9.4 billion. Gross profit went to $8 billion from $7.3 billion. They kept R&D pretty in check. It was up year over year, but they kept it in check. Sales and marketing, they also kept that in check. They actually brought down G&A, which is incredible considering how much their revenue was up. You're looking at revenue up, $800 million roughly? And to bring G&A down when your revenue goes up almost $800 million on a year-over-year basis is very impressive. Now, they had a big restructuring cost here of $260 million. Compared to only a $56 million restructuring cost. So that hurt their operating expenses, right? But still, despite that, income from operations went to $2.18 billion from $1.89 billion. They also had a gain on strategic investments here that was pretty key, $263 million. Now, in the same quarter last year, they had a $217 million loss. Okay, so that matters significantly. Income before income taxes, $2.5 billion versus $1.7 billion. Now, as far as income taxes, they got hit hard this year. Basically, income taxes for the company around doubled year over year, which is a lot of what we kind of been seeing with big tech in this most recent quarter. It seems like more of a short-term phenomenon going on there. But $219 million basically income taxes they had to pay in the same quarter last year. This one they had to pay $426, so a huge step up there. Net income came in at almost $2.1 billion, just a little under $2.1 billion versus $1.5 billion in the same quarter last year. Diluted EPS $2.19 versus $1.58. That's a grade A income statement there. Very, very solid. And Salesforce looks like it's on its way to having A plus income statements. I wouldn't be surprised if we start seeing A pluses cross for this company. What is it going to take for it to get to an A plus? Keep the expense profile down, have that gross profit continue to explode up, get to 10% plus revenue growth, which they should very shortly here. And then we can talk about I want to see gross profit growing even as a faster clip than revenue. And I want to see that net income growing at even a faster clip and EPS growing even faster than that. Okay. Now, something important you got to understand about Salesforce here is we're in a revenue growth acceleration cycle for Salesforce, which is one of the most exciting times you could possibly invest in a stock, in my personal opinion at least, when you're at an actual revenue acceleration phase, essentially. And so if you look at the trailing 12-month revenue, it's about 8.3%. As far as current year expected revenue growth, about 8.7%. That's expected. Analysts are expecting to just under 10% revenue growth for next year. I have Salesforce going to 12% plus. 12% plus revenue growth between some of the acquisitions that they just had clear, right? That's going to boost up revenue in a considerable way. Between Agentforce becoming a bigger part of the business, right? A bigger chunk of the business, and the way the growth rates are there, I have them at a 12% plus run rate for revenue growth in 2026. Keep in mind, I think they're going to be able to keep at that 12% plus clip for years to go in the future. So what are my projections for Salesforce here? My base case, I've been doing 12% on average revenue growth per year, 26 through 29. 20% net income growth, so I've grown at a faster clip because they'll be able to keep expenses down while having that revenue growth continue to come in solid. 27 to 32 P is very fair for a company like this. I'm looking at a CAGR right around 20%, maybe 21% for this stock, between now and then. So solid. Bear case, I still make money on this. Bear case, I still make money. That's phenomenal. If I can run a bear case and I still make money, look at the bear case, how depressing it is. 6% revenue growth? Come on, man. I'll be flipping my flapjacks. That's easy peasy. That's a lemon squeezy for Salesforce. With all the acquisitions they do, with the way Agentforce will continue to take off over the next few years, come on, man. And the way everybody's, has no choice but to use Salesforce. If you're a big business, come on. Okay. As far as Salesforce, sometimes it's nice to just have a stock that is just a money maker and just a chill thing. So I'm buying Salesforce right now. I think I'll make a lot of money in the stock over the next few years. And when they go to report earnings, guess what? I can have the TV on, just chilling. I'm not stressed. I'm not worried. I'm just chilling, man. I'm just chilling. And that's what it's like being a Salesforce shareholder. You're just chilling, man. And I think this will be a good money-making stock over the next few years, but time will tell. Alrighty, next up here. What are my favorite fatty paying dividend stocks out there? Okay, so let's get into this here, okay? First thing up here in regards to these dividend stocks, keep in mind over the next 12 to 24 months, dividend stocks could become, let's call it, much more respected than they've been recently. If we look back at the past, really 3 years, no one really cares about dividend stocks over the past 3 years. Why? Well, you could get 4 to 5% on treasuries. You could get 3 to 4% in savings accounts. Who cares about dividends? If you're getting guaranteed 3 to 5% yield, why do you care about dividends? So if you look, dividend stocks actually, for the most part, have kind of sucked the last 3 years, right? But we have an interesting phenomenon going on right now. You want to know what it is? We have treasuries now dropping considerably. This is the past year for the 5-year treasury, right? And you pull up almost every treasury you want to look at over the past year. It's going down all the way to Chinatown. And I don't see this trend ending. The only way this trend ends is if inflation comes back with a vengeance, and next thing you know, we see CPI go 4 or 5%, which the only way that's going to happen is if you have an overheating, booming economy. Do you see an overheating, booming economy happen in the next 1 to 2 years? I don't know. I don't think there's a super high probability of that. That would be interesting if that happened, but I don't know how realistic that is, right? And so the highest probability is treasuries continue to go down over the next 1 to 2 years, which means if you're getting 3.5% on a high yield savings account right now, right? A year from now, that could be 2.5%. That could be 2%. Over the next 24 months, if T-Man gets what he wants and the Fed just keeps lowering rates and maybe they even buy back treasuries and all these other kind of manipulative things to continue to get treasury yields down, shoot, next thing you know, you might try to go buy a treasury and you might get 2%. Maybe, right? And so dividend stocks become more and more respected and more loved, right? Now, the next thing you got to keep in mind is dividend payout ratio. Dividend payout ratio matters significantly. So for me, the type of dividend stocks I love, keep in mind, I'm a long-term investor. I'm investing in these companies for years. I'm not buying a stock so I can make the dividend for the next month, the next 3 months. I'm thinking about where these companies are paying for dividends 5 years from now, 7 years from now, 10 years from now, because they might pay a small dividend now. Like, I'll give you an example. I have a friend who used to own a ton of Apple stock, okay? Apple first started announcing their dividend, and back then, I think he was only going to make like a few $1,000s a year on all his Apple shares for dividends. So nothing crazy, like a few $1,000s a year. I think it was like $4,000 or $6,000, something like that, right? And I think we did the math, and if he still had all those shares, I think now he would be making easily tens of thousands of dollars a year in dividends, tens of thousands of dollars a year. Okay. So that's why when I talk about, I don't care about necessarily the dividend money I receive right now. I care about a low payout ratio right now in a company that could increase the earnings per share substantially over the next, 3, 5, 7, 10 years. Now we're talking, because I'm thinking about where the dividend income I'm going to be generating from these stocks 5 years from now, 10 years from now, right? That's where we start talking about, how much dividend income could I be making 10 years from now? I could be making 7 figures a year in dividends. 7 figures a year. A decade from now, if I keep on this game, keep on the grind, stay focused, stay disciplined, keep investing strong, I wouldn't be surprised if in 10 years, I'm making 7 figures plus a year in just dividend income. Imagine that, $1 million, $2 million a year in dividend income. Plugging that money right back into more stocks that are more great opportunities for the next batch, right? That's how you play this game fun. And so Payout ratio is very important. I'm looking for companies that have low payout ratios. I'm looking for companies that have a long runway, in my opinion, of EPS growth, so the dividends, they can keep up in those substantially over the next 3, 5, 7, 10 years. So what are some of my favorite? I love Cake. Right now, it may not look crazy. 2.2% dividend yield, nothing too crazy. It's actually less than what you could get on a high yield savings account right now. But what you're missing is Cheesecake has a very low payout ratio. Cheesecake, their earnings per share is likely going to climb in a massive way over the next 5 to 10 years because they have two extremely successful restaurant concepts that are about to expand all over the United States of America. And those two restaurant locations are going to be, the two restaurant concepts are going to be, huge money makers. One's called North Italia, the other's called Flower Child, right? So if I'm thinking about the dividend money I'm receiving from Cake 5 years from now, 10 years from now, it's not even remotely close to what it is today. It's like a whole stratosphere higher, okay? Another one I really like, Nike, 2.5% dividend yield. Nike is a company I look at in just over the next few years. Our profitability is going to come back in a massive way, in my opinion, based upon the trends I'm seeing in the business, the financials, what Elliott Hill's doing with the business. And so this is another one I'm looking at that has huge likely dividend increases coming over future years. So Nike's one I absolutely love. A company I really like that's a dividend stock, Bath & Body Works. Very simple company. They sell soaps and lotions in the malls and whatnot, right? A dividend yield on this one, 4.6%, much stronger than you can get on treasuries now at this point in time, much stronger than you get on like savings accounts and things like that, right? My one thing I'm mad about with this stock is it started going back up recently. It was like $15 just a week or two ago. And I think recently I was looking at it was already like $19. So I'm like, come on, chill. Wynn Resorts. This is one of the most underrated dividend stocks. You look at it right now and it's like, it doesn't seem like a big yield at all, right? Keep in mind they're holding back that yield massively right now because they're building an insane property in the Middle East that is a one-of-one property that nothing like that exists over there right now. And so the opportunity there is unreal, okay? So what you're going to see from Wynn's dividend over the next, we can call it 5 years, 7 years, is going to make the dividend right now look like a complete joke, in my personal opinion, right? Because the Vegas properties will keep bringing in insane money. You have the Macau properties that are looking stronger and stronger, right? And then you have that Middle East property. Oh my gosh, okay? They're going to have so much money, they're not going to know what to do with it all, right? Now you look at some of these other stocks that are like huge yields, right? Like, 8% dividend yield, 7% dividend yield, right? 6.8% dividend yield, 5%, 4%. Look at the issue with a lot of these stocks. Their payout ratios are sky high. 91% payout ratio, 80% payout ratio, 82% payout ratio. The one I saw was a low payout ratio was AT&T here, but AT&T's got insane debt levels, so keep that in mind, right? But look at these payout ratios, they're sky high. And a lot of these companies, guess what's going on with them? Their earnings are going the wrong way. Their earnings per share is shrinking, not going up. Their businesses are actually in decline, not growth. That's a problem, okay? Alrighty, folks, I appreciate you joining me as always. Thanks so much for being here. Once again, pin comment down there. If you're looking to join us in the private stock group, once you join us in there, we'll send you your Steel membership cards to your house, your private group card, your 1000X card, and if you become a lifetime member for the select few, we'll send you your black lifetime membership card. Much love and have a great day.